the hottest story in the commodity sectors are the precious metals, specifically gold and silver. Everybody wants to know where we're going, what are the levels, and that's exactly what you're going to get in today's show. We're going to talk about the levels, we're going to talk about where will the gold price likely go, what are the scenarios, what are the factors, and I'm going to show you a graphic. If you're a gold investor, you really need to know about this graphic because it'll explain to you who the buyers will be for gold's next bull run. Let's get into it. Welcome to Hot Trades of the Day, your show for swing trading ideas for the coming days, weeks, and month. Welcome to Hot Trades of the Day. My name is Daniel Wilhelmi. If you're new to the channel, I hope you had a fantastic weekend. We're glad to have you here. Don't forget to hit the subscribe button so you don't miss any of the videos, because some of the factors that we're going to talk in today's video, we touched on in previous videos. If you follow the channel, if you watch the videos, you knew what was going on. You knew which level to pay attention to, which levels, actually plural, to pay attention to, and could interpret the developments in the gold price the right way. Really nailed the gold price. Silver, about 50-50. That's okay. That gives us 3.5 out of 4, so to speak, right? If we compare the predictions for gold and silver altogether, we're pretty good. We can live with that for sure. So let's get into gold. So I'm back from Deutsche Goldmesse in Frankfurt. And obviously, Friday, not the happiest faces when gold dropped $100 an ounce. It's the typical waterfall sell-offs that we have seen in 2026. Specifically, the March one is the one that we need to pay attention to. Look at it. You kind of go sideways, you have a few red candles, and then the waterfall happens. And here we have the same thing. We kind of topped out here, went a little sideways, lower highs, lower lows, but nothing is really, and then the waterfall happens. Now, where do we stand? I've told you before, 4,500, this is this red line right here. This is the line we need to pay attention to. Why is that? Well, that is on technical levels. We look at the charts. It's a fine line of importance, but not super important. But what is important, that this has been defined as the clear line for the institutions where they will start to buy gold, or if we fall below it, where they're going to radically sell gold positions. And as you can see, the bulls are fighting with 4,500 right here early in Asian trading. We even dropped below it, but then quickly regained it, and the bulls are trying to defend the zone. This is how important this is. So technically, that is the number one level we need to pay attention to. We fall below $4,500 an ounce. We're going to go down to the 200, which is the golden line that you see here in the chart, where also we have this blue horizontal support zone. So we have double support, and this will be around 4,400. So we get below 4,500 on the close. We're going to drop another $100 an ounce in a flash. But then things start to get interesting. Does the 200 hold like it did in March? And we do get the retest and the higher retest, because the 200-day moving average is going up about $50 a week. So, or are we cutting below it, going to this Fibonacci retracement and this uptrend that has been in place since the beginning of 2025 and basically carried this bull run in gold and the run in the mining stocks. So this is a significant long-term support. 4,500, mark your calendars. That's what we need to pay attention to. Now, on the upside, we had two levels defined that were really important. It was this zone right here above the 50-day, this purple line, and this yellow resistance line. And then the next big one obviously would have been this line right here, because that would have marked a new higher high. We have made higher lows, but as I pointed out, we had not made a higher high yet in gold. And that's why I was more bullish on silver, which looked more constructive, because silver had made a higher high and had broken above the 50-day. For gold, I said, here are the levels, and once gold breaks above those, that's when you need to act and adjust your strategy. If we're below the 50, we don't need to worry about anything. And that turned out to be exactly the right strategy. But now, as you can see, the the 50-day moving average is pressing down on us. And interestingly enough, we're getting to a level where the 200, which is moving up, and the 50-day that's moving down, they're going to converge. It's going to get close. It's part, interestingly, of this triangle structure, but it will probably hit a little before. So overall, our bullish structure with this triangle formation as bullish consolidation is still absolutely intact. It's not affected at all by the recent developments. We know from this triangle formation that we will get a decision in mid-August at the latest, maybe even before that. So the downside zones that we need to pay attention to if we break below 4,500, and again, we don't need to do anything until that happens, is this zone right here, 200-day support zone, uptrend, long-term uptrend, and then we got the FIB retracement below it. So 4 factors. I still believe if we hit the uptrend, we will undercut it. There's going to be a liquidity grab happening by institutions that's going to trigger stops, and that they're going to gobble up gold on the cheap. So it'll probably go a little lower. But here's the interesting part. This is the old low, right? 4,098 from March 23rd. So even if we break below the uptrend, let's say it happens around here, that gives us another almost 3% of downside protection before we even make a new low. So meaning, we break the uptrend, we go sell off for another percent. That's a nasty liquidity grab. But it still would mean we're making a higher low in the medium term, right? Short term, the situation is we close below 4,500. We've broken the structure of making higher highs, higher lows. And then again, we have to assume we're going to retest this scenario right here. So this is our zone. The other zone that gets played a lot is obviously 3,500. The retest of the breakout of this long consolidation that we saw basically this time last year, carrying all the way into the fall. That would come into play if we break this triangle formation to the downside. So we'll have a flush sell-off to around 4,000 to 3,890, 3,900. Probably consolidate, try to bounce up. But then we definitely have to assume that this test would come into play, because we also have this long-term uptrend that goes all the way back to 2023. Right? It's the uptrend that carried the big gold breakout, where we broke about basically $2,000 an ounce in March of 2024. So I would also like to point out, if we flip to the weekly, that on the weekly, the 50 weekly moving average is right below our uptrend line, the long-term uptrend that has been in place since the beginning of 2025. So we got big support here. And that's why my scenario, the higher probability still stands that if we go below 4,500, we're getting down to this area. We're going to get a liquidity grab. But that is the downside risk that I see 3,500, I think it is still very unlikely. Why? Because central banks are still buying. Chinese are still buying. Yes, we have the situation in India where the government is actively trying to tell people not to buy gold. That obviously has a factor, a dampening factor. But the real reason is a different one. So let's get into the reasons what's going on with gold. And you know the main fundamental factors that I told you about. Dollar, we talked about it, the Dixie, monster move, broke above the 200, broke above the 50, broke the downtrend. I mean, any way you cut it, this is a really nice looking base right now. You see this? This looks very promising. Unless we sell off now, and this was basically the doink, and we break back below the 50, the dollar looks quite constructive, which then makes sense that gold is not moving. Then we have oil. It's up today. The 50 days pushing it up. That's the line that you need to watch in the oil market. I've been telling you for weeks, I'm not that bearish on oil. I think it looks constructive. It looks good. I didn't get all these ultra bear calls on oil, and it turned out we were right on that one, and that really prevented ugly losses if you were put on massive short positions on oil. That's wild. Why would you do that? There was a good short-term trade for a little profit in oil, but in my opinion, not worth taking the upside risk. So we know the bond market is breaking out, so these are the factors. Well, I'm going to show you a graph that you need to know, a graphic that shows you why nothing is moving in gold. The interesting part is that within the gold sectors, things are moving. We saw a big time takeover last week where Equinox Gold, by the way, I'm a shareholder of Equinox. Full transparency here, I have been for a long, long time. Is buying Orla for a $5.1 billion deal. Orla is a medium-size gold junior producer. So they're taking another one out. Remember, in 2025, they kind of merged with Calibria. Now that will create a senior producer in Equinox. But the interesting part about this for us is the space of the bigger junior producers, so $100,000 to $100,000 an ounce space, it's getting thinned out more and more because these companies are getting taken over. Why? Because in the mining sector, pay close attention to this, gentlemen, size does matter. Now, only in the mining sector, but that is very clear. That means that the remaining junior producers with productions around $200,000 an ounce and good projects with long mine lives, they'll probably trade in a premium. There's probably not that, you're not going to get the big value in this group. The bigger value is going to be in the smaller junior producers that have projects where they're on the trajectory to get to this 6-figure ounce yearly production level, and the advanced developers. Now, I heard this already when I was at the Deutsche Goldmesse over the weekend. Ooh, we're going to see the trickle-down effect to the explorers with the takeovers. We're so far away from that. The market is not honoring just gaining projects and gaining land. That happens in the bubble phase at the very end, not now. So if you're interested in buying explorers, that's fine, knock yourself out. But don't buy them on the concept of, oh, there's going to be a big acquisition run on explorer stocks. That's not where we are. There are always going to be takeovers, certain smaller takeovers. Obviously, it's a huge space. But really what the majors are focused on, and they have the big bucks, right? They're the size does matter. they are focusing on bringing projects into their portfolio that add to the number of ounces they produce or will add fairly soon. That is what the market wants to see. They don't want to see what happened at the end, the late stage cycle of the last gold bull run, where the majors just bought projects just to add theoretical ounces to their reserves and resources. Now, let's get to the graphic. And this is the big one. Excellent graphic from Mentor. White gold price. Green line is the CTA positioning. CTA is, in the modern world, basically refers to hedge funds and quant strategies, which is nothing fancy way of saying it's basically AI-based, algorithm-based trading. And we know in the commodity sector that is usually trend following. I've been telling you this again for as long as this channel has been running. If you don't know what I'm talking about, hit the subscribe button. Now, this graphic was done even before the sell-off on Friday. So the CTA position probably even lower now than you see it in the graphic. It doesn't really matter, because what is important is where do we stand historically. And as you can see, we're at the lowest level we have been in years. And what is really interesting, whenever we were in the region, again, we are at the low end of this region. In the past, you see that was usually a time when things in the gold price started to move. Now, it usually moved a little before, and that makes sense because we just talked about it's trend following models. So something needs to ignite the gold price, and then the CTAs just start to move in and start buying position. You can clearly see, if you look at the rise basically right next to my ugly face, the rise in the green line correlates with the big move in gold. Then the CTA sold off and the gold price basically did nothing. Why didn't it go down? Well, because the central banks were buying. Then again, big move up in the green line. Look at the major rally that led to in the gold price. CTA sold off. What happened? We went sideways. And then on the far right, the last big up move, and you see that was basically what really carried the gold rally that we saw in the fall, winter, and the beginning of this year. And now CTAs have been selling. And what does the gold price do? It basically goes sideways. So there's the reason why nothing is happening. The central banks are buying. We know this. You look at the data. China is buying. Now, we know the Russians are not buying. We know countries like Turkey ain't buying. But still, central banks are adding to their gold reserves. But the gold price is not doing anything. And the reason is because, on the other hand, the mainstream institutions, they are not buying, or they actually were selling. And that is, ladies and gentlemen, that is the group that's going to move the gold price in the next rally. Because the central banks, they're going to buy more aggressively the further gold goes down. That's what going to put in the floor. The gold market is way too big for private investors like us to move the market. We can move the silver market a little bit. That's why it's more volatile. But in gold, it's the big players that make the prices. And the big players are the central banks. And as you can see here, are CTA. And then obviously mainstream investors, banks, outside the hedge fund world, the fund world, the quant world. So there you have it. That's the reason, that's the situation, and we have reached extreme levels. That doesn't mean that gold is going to go back up tomorrow. That doesn't mean that the rally is going to end immediately. But whenever you reach extreme levels in the market, you know that is something that we need to pay attention to. So keep that in the back of your mind as well. The hedge funds, the trend following funds in the commodity sector, they are all out. They're at the lowest investment levels, as you can see, for years. And usually it has been a pretty good timing point, contrarian style, for a change in gold. But in order for that to trigger, again, we need gold to move. How can it move? Well, we really have three factors. Dollar goes down. Gold breaks the 50-day moving average. That is the big level to the upside now. So this line, and I'm going to cut this out now because this one here is skewed, not important anymore. It's really the 50-day because we doinked off here and we doinked off here and it pushed gold down. So the first change of trend for us to pay attention to is the 50-day. And then it's the higher high, and then it's obviously breaking the downtrend and moving above the resistance zones. But the first change will be the 50-day. Breaking above it. That will start getting the first institutions to get back into gold. And then things can move very quickly, as you saw now with the extreme low CTA positions. Obviously, the new Fed chair pointing to maybe no rate hikes or maybe rate cuts down the road, that would be a change of trend in the narrative as well. But for now, what do we need to do now? We need to keep our powder dry, not to be overreactive short term to what's going to happen. We're going to watch 4,500 like a hawk, and then we're going to reassess from there. It'll be really interesting week in gold and in silver and other commodities like copper. I'm going to follow it right here on the channel. Hit the subscribe button. We're going to talk about it tomorrow. Talk to you later. Bye-bye.